So just how safe are our pensions, our banks, and our insurance companies? That's our money, our future. They all rely on the stock market to stay in business and to keep our money growing. We've seen what happens to the market when there's COVID. And so what does government need to do to make sure that our money stays safe? And if you thought the COVID emergency was big, just wait till you get a closer look at the climate emergency. 4 of Canada's capital market and risk experts are on hand to help us figure all of this out. Hi there. Welcome to the Clean50 CleanReset webcast series. I'm your host, Gavin Pitchford, the CEO of Delta Management Group and also the Executive Director of the Canada's Clean50 Awards organization. Delta's 28 years old. Today, we're the only executive search firm in Canada whose practice is now devoted exclusively to green professionals. Our typical mandates include Chief Sustainable Development Officers, ESG analysts, clean tech CEOs, smart building strategy experts, or environmental NGO leaders. As we launched this then new area of practice some 10 years ago, we became aware of 2 things. First, that solving climate change was going to take insight and ideas from every single corner of the economy. And second, that sustainability leaders in different silos were simply not engaging with each other as they needed to be. So to meet that need, we founded the Canada's Clean50 Awards program. And every year since, we've identified, recognized, and most importantly, connected 50 individual leaders, 10 emerging leaders, and the project managers from the top 20 sustainability projects across the country and from every possible segment of the economy. Each year, we bring all of these new honorees together at the annual Clean50 Summit. We connect them with each other and also with our existing Clean50 members. We now have some 600 amazing people who have won Clean50 awards for their impact in fighting climate change. They range from the CEOs and senior executives of organizations like Loblaw, HP, and Unilever, to brilliant R&D scientists, and to entrepreneurs you've never heard of, toiling away at small business and labs and universities across the country. Today, we're presented with the COVID-19 crisis. Typically, when crises hit, governments push panic buttons and jump on any project to create jobs, as long as it's shovel-ready. We build a bridge here, an extra line of highway there, and soon after, the jobs go away. The problem with that approach is that it's incredibly short-sighted and at best a temporary fix. What we need to do instead is to have a clean reset strategy, shovel-ready and shovel-worthy, projects to rebuild Canada's economy and do so with durable long-term jobs in strategic industries. How? By focusing on investing in the low-carbon economy, one that can grow and prosper as climate change increasingly impacts the entire globe. Climate solutions alone are expected to be a $26 trillion opportunity over the next 9 years, and Canada can get its share. But to do so, we need to decide right now if we want to be one of the suppliers or build another lane of highway and become the buyers of those solutions. For every $1 million our government invests in the dying fossil fuel extraction industry, we get just 2.7 jobs. But done right, an investment in just about any part of the low carbon economy generates between 3 and 5 times that number, and as many as nearly 10 times that number. Between 7 and 20 odd jobs per $1 million of investment, depending upon the industry segment. Best of all, a lot of that investment is just that, an investment, money that will be repaid or recouped by taxpayers, not swallowed up because some Saudi-based oil sheikh or the Russian oligarch decided to bump production and push down oil prices to a number that puts Canada out of business. When the COVID crisis hit, about 100 of our members immediately recognized we had this once-in-a-lifetime opportunity, that when we reset, that when we use that incoming government impetus spending, we could do so to set Canada on a clear path to a more prosperous future where we export our brain power instead of our resources. 58% of Canadians support that idea. This group of industry experts spent several weeks working on a plan as to how we might best invest government stimulus spending to expand our low carbon economy. And then on Earth Day, we put that plan forward in a letter to the government, ultimately signed by over 220 members of the Clean50, 170 of their employers, ranging from multinationals like HP Canada and Unilever to small, medium enterprises. Another 35 organizations, including the Green Party of Canada and the Canadian Association of Physicians for the Environment, immediately endorsed the plan. The latter said our plan wouldn't just create jobs, it would save lives and cut government health costs. And now, via a series of web and podcasts, we're bringing together expert panels to discuss various elements of our Clean Reset plan and discuss the ways in which our proposals can help Canada rebuild with a low carbon economy and millions of future-proof and durable jobs. Today's panel discussion addresses some of the aspects of the post-COVID Clean Reset from the perspectives of capital market, regulation and taxation, and government actions that can strengthen Canada's economy and resilience going forward. Nothing lays bare just how vulnerable the global economy is and how exposed our Canadian economy is than a pandemic. All of a sudden we realize everything is dependent upon something else or someone else. China has all the masks. The USA buys up all the global supply of the only known drug to help stop COVID, remdesivir. Supply chains collapse while we need ventilators. We think that perhaps we can solve the problem with 3D printers, but the factory building and shipping them in Wisconsin is closed by an outbreak, and in any event, they can't get parts from China. Hopefully there will soon be a vaccine for COVID-19, but there is no vaccine for climate change. We saw how COVID killed the economy in the space of less than a month. Imagine what the sustained assault of climate change is going to do to Canada going forward. Many of the companies that are affected by global events are public companies. Their shares form part of our pension plans, how our insurance claims get paid out, and how banks make enough money to secure our deposits and still loan us mortgage money. Many stocks were proven to be hugely vulnerable to a temporary crisis. Profits have tumbled, losses have mounted. Where does that leave our pensions? And how much worse will climate change make everything? All of these things are considered risk, and it's critical to our economy, our prosperity, and our very future that these risks are well understood by those responsible for our pensions, our banks, and our insurance payouts. What's becoming much more clear is that risks are coming from new and unexpected places. Climate is one aspect, but reputational risk is increasingly an issue. Think about Facebook's policy on content, which led to dozens of major brands abandoning Facebook as an advertising platform in the space of just 10 days. Consumers dropping brands who have racist slogans or lack board diversity, or whose boards or C-suite are tone deaf on matters pertaining to race, employee wellness, etc. Many of these risks are considered by professionals who take ESG factors into their assessments of a stock's long-term value. ESG stands for environment, social, and governance. You'll hear about ESG today and also about RI, responsible investing. It usually refers to investments that heavily factor ESG into their decision-making, but also reject investments in organizations that harm the environment. It was often thought that one gave up potential gains by considering these factors, but COVID has proved that wasn't the case. It turns out that companies that score well on ESG are just really well managed. They have much more secure supply chains, are more resilient, and thus are also less exposed to pandemics. ESG investment funds on average did far better than most regular funds when the stock market crashed back in March and April. Pandemic risk is unpredictable. Climate risk is more predictable, but still some specific unknowns. And what is completely predictable is that Canada and Canadians will rely upon the Canadian pension plans and their banks and their insurance companies. How do we incorporate those factors into our post-COVID clean reset? And how do we embed policies that will reduce our impact on and our exposure to climate change? That's our discussion today. Barbara Zvan is the former Chief Risk and Strategy Officer for the Ontario Teachers' Pension Plan, where she also crafted the plan's responsible investing and climate risk management strategies. Barbara actively contributes to the boards of various global and Canadian institutions and associations focused on pension management, risk, and responsible investing. She was a member of the
Government of Canada's expert panel on sustainable finance and became a member of the 2020 Clean50 last October. Barbara, in support of our emerging clean tech industry, the Clean50 Earth Day open letter to government specifically endorsed unlocking private sector investment as described by the expert panel on sustainable finance. Would you please remind us of the thinking behind and the key recommendations of the expert panel, and let us know where we stand on that and other related initiatives?
Our goal was to give a package of practical, concrete recommendations, really to spur the essential market activities, behaviors, and structures to make sustainable finance mainstream. We really wanted to take a systems approach, so many things need to happen. So please, one of the key takeaways I'm hoping people will leave with is that it's not just a role for governments, it's a role for governments, communities, investors, and citizens. Now, normally people will talk about the challenges, and Canada does obviously have a few. A couple important ones is that, as I mentioned, we have a large oil and gas sector, mainly concentrated in Alberta, and so just transition is very important for Canada. And we have a federated system where regulatory aspects are shared at the federal, provincial, and municipal levels. However, we have one key advantage. Our financial sector is relatively concentrated. And so when you look at the top 5 banks, the top 7 banks, you have a large sector of the banking sector. The top 5 insurers would be 2/3 of that market. Top 5 P&C would be over half. And the top 8 pension plans are 75% of the assets. So you throw in perhaps with the CEO of the TMX, and with less than 30 CEOs, you have the lion's share of the financial sector in a room. And so you can actually have intelligent conversations and talk about change. So in terms of our overarching themes, first, we really had 3 that really informed our recommendations. The first was that environmental and economic aspirations need to become one and the same. And ultimately, they can't be divided. You can't just do environment. You can't just do economic. You need to address them together. A second theme was that we have catching up to do as Canada, but we think Canada can be among the leaders in the global transition to a low-emission future and be a trusted source of climate solutions. And the third is that sustainable finance has to become mainstream. So when you look at the report, there are really 3 pillars in the report, which really house all our recommendations. The first pillar is about opportunity versus thinking about it as burden. The second pillar is about key foundations, and the third is about the financial products and markets. And I was going to talk briefly about each and the motivation. The first pillar really came because we saw really 2 camps, people who talked about climate change and about the opportunities to do investments and about the change that could happen positively. And we saw a group who talked about it in terms of burden. And we really wanted to make sure that Canadians saw the things that we needed to do as opportunities. And so there's recommendations like figuring out the strategies for key sectors, creating opportunities for people to invest sustainably, and to bring an action council together to bring the signal and the voices of those CEOs out into the mainstream. Pillar 2 was really about the foundations. And so what do we talk about there? So these are the things that you need every day to help with decision making. So it's about data and analytical capability. It's about information and disclosure. It's about legal clarity, and it's about supportive professional associations with training that's actually helpful to bring these skill sets to bear. And then pillar 3 was really about certain financial products and markets. And so if you think of Canada, what do we need? What kind of markets do we need? And here's the recommendations around a transition taxonomy. How can we define investments or a taxonomy to say these are the things that will help us transition? It's about how can we improve the investing in clean tech? How can we change the conversation in oil and gas, infrastructure, buildings, and real estate? So those would be the key pillars. And then since the report was published, it was around June 7th or so of 2019. It was summer, and then we went into a fall election, which then, in terms of process, as many people know, ministers are appointed and mandate documents are created, or mandate letters. And so we were working very much toward the spring budget, which we were hoping would be late March, early April. And we had some really great progress. We had the House and Commons Finance Committee top ask was actually to implement the expert panel's recommendations. So we were very pleased with that. And in early March, there was a breakfast with Minister Murnau, who at that time was obviously addressing some of the impacts from COVID, but very specifically noted the recommendations from the expert panel. Since then, I think the government has been rightly focused in, and many organizations and citizens have been focused in on COVID, but we've seen some change even then, with the government including a disclosure element in one of their emergency programs for large companies. We've seen groups come together, like the Task Force for Resilient Recovery, to talk about how to build back better. And we actually seen one of the recommendations from a transition taxonomy, a group of private industry come together and actually work on that transition taxonomy for a release in August. So really great progress in that area, given everything else that they've had to deal with at the same time.
Thank you so much, Barbara. And also, thanks so much for all the important work that you did on the expert panel. Next, I'd like to understand where things stand on the ground right now, how corporates and investors are looking at responsible investment. And for that, I want to ask Mila Craig to fill us in. Mila has many years of experience working with both investors and corporates in previous roles in institutional equity, as Deloitte's sustainability leader in Quebec, and most recently as the founder and president of Milani, an ESG consulting firm that works with investors on their ESG integration strategies and works with corporates on identifying and communicating their key ESG issues. She also serves as a board member of the Responsible Investment Association, and she was named to the 2017 Clean50. Mila, over to you. Where are we from your perspective?
Over the past number of years, we've seen a lot of research that suggested that ESG funds would actually do better in periods of volatility. And what we saw during the March and April 2020 timeframe as the global capital markets were collapsing is that ESG funds perform better than traditional funds. Of the 2,800 ESG labeled funds that Bloomberg tracks, about 400 of those ESG funds actually remained in positive territory during that market corrections, which means that they didn't actually lose money. So this was really a stress test for ESG and ESG funds, and it's caused something very important to happen since. So there's something in the market called ESG exchange traded funds, or ETFs, which are funds that have a much lower fee that you pay as an investor, but funds that are invested very broadly across the whole market. And what we started to see is money flowing into these ESG ETFs during the crisis versus money being retracted, which you might think would happen. This has led to more and more money flowing into responsible investment products. And in fact, in April in the US, the money flowing into these types of funds were larger than any amount going into them since they've been tracked, which was estimated at around $5.7 billion in April alone. Here in Canada, we've heard about record numbers as well flowing into ESG ETFs, with the latest estimates by TD Securities just last week showing year-to-date about 740 million Canadian dollars versus 142 million just last year. As we began 2020, there had been a lot of momentum supported by the CEO of BlackRock, the largest asset manager in the world, who committed in his yearly letter to put climate change and sustainability at the center of their strategy. And when they made that announcement, they had a record amount of inflows into their funds overnight. We also had the U.S. Business Roundtable Statement of Purpose, where we had over 180 CEOs committing that their business purpose was to all stakeholders and not just to shareholders. We've had global credit rating agencies who influence significantly the pricing that an organization will have to pay for lending. They have aggressively moved into the ESG space as well through the acquisition of various ESG rating firms, some like Michael's competitors. as well as a record level of issuances of new sustainable finance products like green bonds and sustainability-linked loans. We undertook to do an institutional investor sentiment study to see how the largest of Canadian investors were reacting to the COVID crisis. What was interesting was that 74% of those investors said that the COVID-19 pandemic had shown that E, S, and G issues matter to investors. And overwhelmingly, we heard that they felt that there was just so many initiatives pushing forward investors, corporates, and boards of directors of companies that with this exploding momentum around ESG, that it simply was not going to go away, and it was only going to intensify within the investment community. And that's obviously been noted by the fund flows that I just mentioned. But there's still many investment organizations that have not advanced in integrating these ESG issues into their investment processes. And I think this is where we would be looking for some key action. And it was one of the elements of the expert panel that Barb mentioned earlier. And that was that we could be looking to the Minister of Finance to clarify the duties of investors to take these climate change issues and ESG issues into consideration on behalf of their beneficiaries. And that's something called fiduciary duty. But the majority of the respondents, 87% of them, actually confirmed that they expect climate change will remain a priority throughout 2020 and well beyond. They expressed that they consider climate change as a long-term issue, and that they felt that the current situation was only going to amplify how organizations would consider climate change in their risk assessment. And that leads to this question about directors' responsibility. Just last week, we had a new report published called Putting Climate Change Risk on the Boardroom Table by a very distinguished Canadian corporate governance expert and lawyer, Carol Hansel. And she'd been asked whether directors of Canadian companies are obliged to address climate change risk. And she noted that the answer is clearly yes. She's been very clear about the responsibility of directors to include climate risks and opportunities in their oversight and the strategic direction of companies as they serve, and noted that these obligations transcend any one director's or officer's personal opinions about climate change. And it was also noted that it's now a director's responsibility. It's not for them to wait for management to identify these issues and bring them forward. It's really that it needs to be on the board agenda, and that they must be receiving reports and recommendations going beyond just being educated, that it really is a board responsibility. And maybe I'm going to hit my last point, because it leads to the third and last point that I have, which is that for investors to be able to invest well with this ESG lens, there's a need for those entities in which investors invest to disclose information around ESG issues, which Barb just mentioned earlier. And in our study, it was noted that the COVID-19 pandemic has actually provided investors with new information about how companies were managing various social issues, and that they were getting information that they don't normally get in disclosures from organizations, which they felt would impact either the business resiliency, the business continuity, or the reputation of that organization going forward. So 65% of those investors are expecting better disclosure from companies, but they want this disclosure to be on issues that are financially material to the business. Yet without some specific standards and frameworks being required, the information is all over the place. And I'm sure Michael can speak more to that.
Thanks so much, Mila. When it comes to capital markets, Canada is a big player on the world market. It's unlikely we could start a trend and still continue to attract investment. We definitely need to keep up with evolving international trends. And there's one Canadian who has long played a role in providing data to international capital markets. And we're lucky today to have Michael Jantzi joining us from a COVID hideout somewhere in rural Ontario. Michael is the CEO of Sustainalytics. It's a global leader in ESG research, ratings, and data. In addition to 2 Clean50 awards for Michael personally, Sustainalytics has been recognized as one of the top 2 responsible investment research firms in the world for the past 7 consecutive years, and has also won several awards for its work with green bonds. Michael has over 30 years in this field, serves on the boards of both Tides Canada and the Principles for Responsible Investment. He was part of both the very first 2012 Clean 50 and the most recent, the 2020 Clean 50. Michael, would you please share what you're seeing and give us some perspective on where Canada sits internationally, as well as just your thoughts generally?
Thank you, Gavin. Again, like others, it's a pleasure to be invited to be part of this panel and to talk about these issues that are so important, especially as we think about what the world needs to look like coming out of the pandemic. So, Gavin, you mentioned the fact that from a capital markets perspective, Canada isn't thought of in a lot of ways as a significant player. But the fact of the matter is we have one of the most respected pension systems in the world, has already been noted. We have a strong financial system. And so in some ways, I think Canada punches above its weight if you were simply to measure our markets on a capitalization basis. So Canada has a lot to contribute and has, but when it does come to this idea of ESG and responsible investment, we have as a country been more of a taker and a laggard as opposed to a leader. And so I think that's changing, and we have an opportunity to grasp the mantle of leadership now in a way that we've been maybe a little bit shy to do. But the fact of the matter is, as Barb and Mila have talked about, is this idea that environmental social issues are now business and investment risks and opportunities that have to be accounted for in decision making is fairly well entrenched. And certainly when you look globally, if you go back to this construct of fiduciary duty, whether it's for an investor or for a board of directors, the idea that you have to account for environmental risk, for example, it just has a lot more traction than it did even 5 years ago and certainly 10 years ago. And, fiduciary duty is a fancy term, but it's an important one. And, from an investment perspective, it's fairly simple. And when you are entrusted with overseeing or managing somebody else's money, their assets, it's critical that you are held to the highest standards. That's fundamental, and no one is arguing that. And that this idea that as a professional you have the best interests of your client or your beneficiary at the top of your agenda and the center of your thinking is critical. The problem has been that best interest has been very narrowly defined, at least historically, and fiduciary duty has been a shield behind which professional money managers and pension fund managers and those in the capital markets have hidden from, I guess, this understanding that environmental and social issues are issues that are important.
How is fiduciary duty and environment seen elsewhere in the world?
Gavin, you can go to most places around the world now, whether it's in Europe or Australia, increasingly across Asia, and even here in North America. And as we've heard, the idea that climate, other environmental issues, social issues such as human capital, supply chain risk, and so on, these are better understood now as things that investors have to integrate into the investment decision-making process. That is something that it's hard to argue against. That doesn't mean everybody has implemented that in the fullest way possible. It doesn't mean you're still not getting pushback against that construct, but it's understood in ways, and that's certainly true in Canada. So the question is, where does Canada stand on that? And certainly, we've talked about the fact that our financial markets are fairly concentrated. In some ways, that may not be beneficial. I think when it comes to responsible investment, as Barb already mentioned, it's a potential plus for us, because the fact of the matter is that pension funds in Canada, for example, are integrating ESG and do see the seriousness of it and provide a good example, I think, for their brethren across the country. But it's also clear, and the expert panel, this is one of their key recommendations. We need clarity from those regulators from federal and provincial governments to just come out and say what other jurisdictions around the world have said long ago. It's okay to look at environmental and social issues as part of the investment process. And in fact, it may not be okay to ignore them, in fact, so that it's absolutely part of a prudent investment process to consider environmental, social, and governance issues as part of that from both a risk management and an opportunity standpoint. And that may seem like a fairly simple statement or a fairly simple ask of government, but it's an important one. I think the other thing that is important to note at both provincial and federal government levels that, sometimes actions speak louder than words. So in addition to being very clear in regards to the fiduciary mandate and clarity around that in law, I think it's important that we start to see that practice by the federal government, for example, where it in fact is managing assets on behalf of Canadians. And from a global perspective, it is clear that assets are now being managed in a way that very seriously consider climate risk, for example. And of course, capital is global. I mean, investors have a choice. They can allocate that capital anywhere in the world to any sector that they wish.
Compared with the international market, how does Canada rank there, Michael?
The message that may not be too easy to hear for Canadians is that Canada does not rank well in terms of the public policy environments that we have at a federal government and provincial level, because that's a part of for pension fund managers. They want to see long-term proactive stability in the oversight and the public policy side. We're not there yet in Canada vis-a-vis many other jurisdictions. They want to have the opportunity to invest in companies that they believe are positioned better for long term, and that undoubtedly now means transition to lower carbon economies. They want to understand that the companies they're investing in understand and are managing those risks, but maybe more importantly now are transitioning business models to take on the opportunity that is undoubtedly there. And that's where, we don't rank as high as a country across sectors at different levels of government. And so that is really, again, what the expert panel was trying to address and what all of us have been talking about today.
How important is that, Michael?
It's important that we grasp this opportunity, because one of the things that maybe we'll return to is that whatever policy instruments we may choose to use, time is of the essence. And this is one of the key things that I took out of the Bank of Canada report was whatever policy instruments the federal government chooses to employ, it's clearly something that we have to do more quickly. And if we wait, the outcome simply won't be there or as positive.
Michael, are you seeing an evolving trend?
Coming back to my opening point on fiduciary responsibility, if Canada is a little bit behind the game now in regards to this on both the corporate level and on the investment level, I think we also have to understand that fiduciary duty is an evolving concept. It continues to evolve. And just as we've evolved from a situation where investors only looked at those traditional financial parameters, are now opening up that lens to include environmental and social issues as part of the risk and opportunity framework. We are starting, or at least I'm starting to see in other parts of the world, most predominantly Europe, where fiduciary duty is now beginning to encompass a desire to invest in that transition, to invest in companies that are moving away from old business models to address transition and other sustainable development goals, simply because investors believe they have a responsibility to do so. So this is much too early from my perspective to call a trend, but it's interesting because, again, the idea that you integrate these issues into an investment decision, I would say, is well understood. That's what the last 10 years are about. That's about the impact, environment has on your portfolio. I really believe that the next decade is going to be about the impact portfolios have on the environment and have on social issues. And if we start to see large pools of capital beginning to really buy into that idea that they have a responsibility to be part of the solution, aside from that traditional, I have a risk to manage and an opportunity to take advantage of, I think you're going to see a very powerful and Mila already mentioned the flows into ESG funds. I think that that's going to be child's play to what we might see. And if we are not prepared as a country to position ourselves for that sort of investment eventuality, it's not going to be a very pretty picture for us. So we have an opportunity. Time is of the essence, and I think that's what we're talking about today.
Thank you, Michael. That's a remarkable summary. So we're talking about investment markets, but now let's turn to how do these issues impact the economy writ large. For that, we're going to turn to economist Chris Reagan. Christopher is an economist and the director of the Max Bell School of Public Policy at McGill. He was the chair of Canada's Eco-Fiscal Commission and was also a member of the Federal Finance Minister's Advisory Council on Economic Growth. Chris has also served as the Clifford Clark Visiting Economist at Finance Canada and as a special advisor to the Governor of the Bank of Canada. Chris, there's two things we'd like your opinion on. First, how do the principles of responsible investing play into the larger and ideally lower carbon economy? And second, what kinds of reforms would you like to see from government that would accelerate that transition?
Okay, the first question, how do the socially responsible investment ESG world, how does it impact the economy? How does it perhaps unfold? I want to come back to something that Michael said on this. He said more or less that it is now well entrenched that ESG thinking is necessary in the business and finance world. I apologize if I didn't get the words right, but I think I've got the essence right. And I think he's right. I think he's right in large parts of business and finance, that it is now viewed as something that we have to do, not that it's required to do, but we have to do. I think our consumers expect it of us as businesses, our investors expect it of us, and in many cases I think business leaders think it's the right thing to do. So I think all of that is good. But I am struck by still how much I think business leaders don't know the next step. Now, I think there are going to be big differences across the business and finance community. I think there are some people and some organizations that are on top of this. But I'll give you one recent anecdote of mine that helped to convince me that there was still a huge amount of work to do in the industry by people like Mila. So I was sitting in my office at the Max Bell School of Public Policy, what seems like a lifetime ago now. I think it was a couple of weeks before Christmas. And two people came in to see me, and they were senior executives at a very major financial firm, a very major Canadian financial firm that I will not name. And they had just come from a meeting with their board of directors a couple of days earlier. And the board of directors of this major firm had said, climate risk. So we got to get on that. And the board of directors said, we don't even know where to start. We don't know really what it means. We don't know what to do. And so they looked at these two people and they basically gave them an assignment. Can you guys figure that out? Can just handle that, would you? So these two people came to my office and they conveyed this story. So they said, so we don't really know what to do either. We don't know really how to think about this. So do you want to help us? And I thought, I kind of looked behind me as if maybe they were talking to somebody else. And I thought, well, this is great that you're talking about this. I think it's really important and really valuable that you're taking these steps. And they were looking for something to be done by the end of the month. by the end of the month. This was 2 weeks, maybe 3 weeks from now, by the end of the month. And I thought, I think it's a bigger job than this. And my sense, we started talking about this, and my sense was that they didn't even make the distinction between three things that I think are an absolutely crucial distinction that any business, if they're thinking about this thing called climate risk, I would recommend that they make the distinction between three different things. And by the way, every time I use the word risk, I will use it in a statistical sense. So think about somebody walking into a casino. They face all kinds of risk. There's a risk that they may walk out a millionaire. There's a risk also that they will walk out having blown all of their money, right? So a risk is both a good thing and a bad thing. So the way we typically talk about this is risk and opportunities. But my point is to think about both sides of this. Three different types of risk. One is risks and opportunities confronted by climate change itself. So just imagine you are CN Rail, and there's a chance that a greater frequency of floods wipes out your bridges or wipes out your tracks. Well, that's a very real business risk for a company like CN Rail, and it's fundamentally about climate change, okay? And there may be positives there as well, not in terms of wiping out your tracks, but climate change that actually does warm disproportionately in northern environments, like Barb was talking about, may actually lead to the increase in some crops. And if you're CN Rail, it may actually lead to increased business of transporting some of those crops to Tidewater. So there are, CN Rail could imagine both opportunities and risks confronted by climate change itself. That's one bin. The second bin of risks and opportunities are the risks and opportunities that come from policy that is directed to address climate change. Now that's very different. So imagine a clean fuel standard that we may have federally in this country at some point. We have also in parts of this country. A clean fuel standard creates risks and opportunities for different industries in different ways. A carbon price creates risks and opportunities for different parts of businesses. I mean, a carbon price is going to drive up the fuel that CN Rail uses. It's also going to increase the demand for wind power, which will actually be an opportunity in a different industry. So climate policy drives risks and opportunities, and it drives it differentially for different players even in the same industry. So let me switch now my examples away from the rail industry toward oil sands producers. There are big differences among oil sands producers about the carbon intensity of their production. Suncor and Husky actually look quite different in terms of the carbon intensity of their production in the oil sands. And those differences mean that they will actually be, their risk or opportunities will actually be quite different, and in terms of how they respond to not just the carbon price, but more importantly, the output-based pricing system that they face, in wherever they're producing, typically in Alberta. So, Gavin, if you want to ask about output-based pricing system, we can talk about that. But it's effectively a way that governments are getting firms, getting large of it is okay. You don't want to talk about that, but it's basically a way that governments can get firms to pay a carbon price, but at the same time protect their competitiveness by effectively giving them financial support based on how much output they produce. But that output-based pricing system, carbon price combination, has a differential impact on the bottom line of Suncor versus Husky, just to take two examples. So those are all exposures to policy risk or opportunities. And the third bundle is market risk and opportunities. So as climate changes and as policies about climate change around the world, markets are going to change. And those market changes are going to create opportunities for some firms and industries, and they're going to create risks for some firms and industries. So, over time, if the world moves actively and continues moving actively to address climate change, it's probably going to result in a reduction in demand for fossil fuels. Okay, it may take a while before that really starts to kick in, but probably those policies around the world will tend to dampen demand or outright reduce demand for fossil fuels. Those are clearly risks if you're a fossil fuel producer. They're clearly opportunities if you are in, producing cleaner power alternatives. So those three things, whether you were Suncor or Royal Bank or CN Rail or Canadian Tire, it seems to me you want to be thinking about how your business is exposed to climate change, how it's exposed to the risks associated with climate policy, and how it's exposed to the risks associated with simply market changes, market evolutions that are coming from climate and climate policy. Those three different things, I think we are very much at the beginning of businesses thinking very systematically about these things. And as I said at the beginning, I think some businesses are way further down this road than most. But I suspect the next 10 years is going to see a huge expansion of not just the number of firms and businesses that are thinking about this, but the precision with which they are thinking about this. And I think that precision is going to be really important. Let me just turn quickly, Gavin, to your second question, which is what sort of policy reform I think would be great. Well, I'll mention two that I think would go hand in hand to driving this sort of thinking. One is to continue pushing ahead on a carbon price, because I think a carbon price in this country, the federal backstop carbon price is at about $30 per ton. It's scheduled to be $50 per ton by 2022. The federal government has no current plan to raise it above $50. My fear, and it has been my fear since this government was elected, is that they would not push that carbon price to where I think it should be. I would like to see Canada's carbon price, whether it's done provincially or whether it's done with a federal backstop, I would like to see that carbon price in the ballpark of $150 per ton by 2030. That would put gasoline up in price still to below where it was about 6 months ago, and well below where it was in the fall of 2014 before the world price of oil shrank. But what a rising carbon price would do is that it would simply make it more important for businesses to be thinking about these risks. Because all of a sudden these things, especially the ones coming from the carbon or the climate policy itself, it would simply make these more important. And the second policy initiative would be to make it mandatory for businesses to actually report on these risks. So, as you all know, publicly traded companies are required to have a certain level and a certain detail and a certain quality of financial reporting. Some of them might want to do it on their own anyway because it's demanded by their investors, but we actually have regulations for publicly traded companies that they must report in a certain frequency with a certain quality of data and the nature of data. Well, we could simply pass that sort of law or legislation that requires reporting with the same sort of frequency on climate risks. I think if we did do that, we would probably start off with a few requirements, and then over time, as not only businesses learned, but governments learned what sorts of things should be reported, how should they be reported, we would learn over time, and the nature of that reporting would change over time. We wouldn't get it right straight out of the gates. It would take us several years, I suspect, to improve and to ultimately perfect that style of reporting. But I do think that a rising carbon price and mandatory reporting, those two things would mesh beautifully. They would go hand in hand very well. And then, as we've heard from Michael and Mila and Barb, once you actually have that reporting and those risks being taken into account, you start to see different behavior I think that in a very serious way over time about the flows of financial capital in the economy in the direction that we, I think, all agree we want it to go.
Thank you, Chris. I do want to come back to one point just for half a second. A rising carbon price actually helps CN, I think, in some ways, just simply because they get to they are the lowest carbon transportation solution. Maybe address that the next time we come back to you, Chris. I'll leave the question quite open-ended. We're looking for change in Canada on a wide variety of things where finance can help us get there. The way in which we pay for things, the way in which we consume things, and the way in which we invest can make a difference on our climate impacts. What else is important? What else do we need to be thinking about? And I'll leave it open to you guys to throw open an idea.
So maybe I'll highlight a few policies that were in the expert panel that are maybe not as well known as, say, carbon pricing. So one of the key recommendations was around how do you change opportunities around investing. So we encourage, for example, a super deduction around retirement savings for people who invest in sustainable products. That's a tall order, but what would that do in terms of impact? And this would be hard to price, but that would engage definitely the organizations that provide these products, who today, as the example was, probably are still just starting to think about it. It would say, how do I provide a product, which means I have to train people, I have to develop what meets the criteria of sustainable finance, and actually start creating change in the financial sector. And it was really the motivation. So one way you can think of policies, how can I create things that will motivate organizations to help create solutions? And we thought that could be one of them. It could also be around simple things like data. So if you think of the government providing financing for various things going forward, keep the data to show that it is going to be a viable investment for the private sector. Make it standardized, make it open, make it transparent. And these could be a good foundation, not a lot of money to keep that data, but then help bring in private money so it's not always the government funding solutions. And the last thing would also be to encourage groups like the accountants. The accountants play a hugely important role in valuing a company. And today there's no guidance in terms of how to incorporate climate change. So how can you help the creation of those sorts of guidance and really spur change? What we used to say is take it from the risk page of a deal deck into the actual spreadsheet of someone valuing a company. And again, not huge dollars for the government, but really key in terms of motivating change in behavior.
Is there an argument to be made, and I think we've discussed this privately before, that what is really critical to our ability to move forward is to set some durable policy that will survive a government and be sticky and enable business to prepare and think in 10-year cycles instead of election cycles?
One of the commentary from the investment community is actually about making this a just transition. And how important it is that it is a broader, that the social aspect is integrated into this conversation. And Barb gave some stats earlier on about some of the potential implications, but it's really about, as we transition, about not leaving people behind as well. And I think that's often where the conversation, where we get people in defensive positions, is because as they look at specific industries, and I think Alberta is that example of, when we look at the oil and gas sector, what does transition look like? And it may potentially mean a lot of lost jobs and lost communities. And these are the things that politicians aren't so great at looking beyond. And I would just also say it's not just about Alberta, because coming from PEI, the reality is a large number of people from PEI in the Maritimes are actually employed in Alberta. So there are huge implications, and I think one of the biggest pieces of this conversation that the investor community is starting to think seriously about, and Michael brought that up earlier, is about the impact of all of this as well. So I'm just going to throw that in as, because I think it is a challenging point for politicians to look beyond 4 years, but I think we really need them to, because this has to be about a longer term transition.
Inordinately difficult and challenging questions that we're grappling with here today. And one of the things that I grapple with is what I think is the need to move quickly. But I absolutely take Chris's point that bad public policy is maybe worse than no public policy. But one thing I do know, and maybe this gets to your question a little bit, Gavin, about longer term, if we do nothing, the market will make the decision for us. The issue for me is I'm less, I guess, focused on all of the other things. I'm more interested and believe that time is so important. I do think that COVID-19, alongside the risks that Mila highlighted earlier, I do think that it is shown that countries that acted sooner rather than later and in a more meaningful way had better outcomes than those that didn't. So to me, those are the lessons that we need to take in regards to public policy, in regards to this issue. We do not have the luxury of time. So, I don't know, aside from the carbon tax, exactly what the right things to do are. We maybe have a little bit of time to work through that. But we need to move meaningfully and more aggressively on those tools that seem to have a lot of consensus. Democracy or not, and 4-year election cycles or not, I do think that people maybe are more tolerant now of public policy that is a little bit more painful for them in the short term if they believe that those decisions are going to be beneficial for them over the medium to long term.
It was great to see the government actually implement one of the expert panel's recommendation around better disclosure in one of their relief packages. So many people may have heard the acronym LEAF. It's the Large Employer Emergency Financing Facility. And in there, there's many, these are companies are currently struggling, but it was recognized as they need to build back better, that they need to be more resilient. And one of the really important factors that they have to think about is climate change. So asking for more thought and consideration around their climate reporting as they move forward, still in a paced and phased ways as people are learning, was a really strong signal to say, if we're going to help you get through this difficult time, we will want you to get prepared for the next difficult time. And disclosure is one means to do that, because by having to disclose, I can tell you that it creates a whole bunch of organizational change in the background to actually be able to say, how are we going to talk about our climate strategy? How are we going to talk about our climate change risk management? What metrics are we going to use? What targets we're going to use? So it was great to see the government do that for that particular piece for large companies who really can tackle that.
With this, then, I'm going to turn to each of you and ask you for if there was one thing you could ask for, or if there's one final message that you have for government.
For me, the number one is fiduciary duty. And the reason I say that is because money makes things move. And I think by making it clear that ultimately the whole investor community will move, and by doing so, capitals will flow and the costs of it. I think we've talked all about it, about market pricing, et cetera. But I think that's one of the biggest things that the government can do is clarify that and make sure that that money flows in the proper directions to support all the other elements.
I second that. I think mandatory financial reporting on kind of all risks related to climate in the way that I described earlier, I think would be great. And the second thing is that I think the federal government needs to actually believe that a rising carbon price can achieve much of what they want to achieve, and they should have faith in it, and they should actually push well beyond $50 in 2022. And remember that with the rising carbon price in the federal government, you get very significant rebates to households. So I just continue on that front, and then think very carefully about other policies. But I would put a clear emphasis on a rising carbon price.
I will support exactly what Chris just said on carbon price unequivocally. Absolutely important. I will again echo Mila's comments in regards to fiduciary duty and setting a policy tone. And I'll just add one element to that. And that is that as the government provides clarity around how those in financial markets should be looking at environmental, social risks and opportunities, I would say very strongly that actions speak louder than words, and that they should ensure that where they have control and oversight of financial assets, that they practice what they preach and implement a high standard and rigor around the integration of environmental and social issues into their own investment and economic and financial decision making.
Maybe just as a last thought, we've talked a lot about mitigation, but we have to focus both on adaptation and mitigation to really be prepared for climate change. And it's going to be a really multifaceted approach. And I think many suggestions are great ones, but we really have a lot to do. And it's throughout the different governments, throughout the different government departments, through the corporations, through citizens, through investors. And it's really about how do we bring the right groups together to get things done.
I'd like to thank our esteemed Clean50 panel on how to pull the levers on the finance side to better enable a post-COVID clean reset. Barbara Zvan, Mila Craig, Michael Jantzi, and Christopher Reagan, thank you so much for being here. The key things about which there was universal agreement amongst our guests are these. First and foremost, the carbon price needs to remain and to get bigger and do so faster. That will drive change and also enable bigger rebates to individual taxpayers. Second, the inclusion of ESG factors in investments is growing worldwide as investors take increasing notice of environmental, social, and governance issues in assessing whether a company is one in which they care to invest or not. Canadian issuers and investors are both lagging here, and we need to catch up or risk being considered a higher risk place to invest for both international and institutional investors. Third, an excellent way to help accelerate that trend in Canada would be for governments to better define what fiduciary duty means and the obligation it imposes upon those making investment decisions for their clients. Finally, we heard that government can walk the talk. Governments control many billions in pension and treasury funds and can set a critical example by demanding their own money managers take ESG factors into account and include climate amongst those. One of the fastest ways to ensure companies transition to better stewardship of the environment is to stop investing in ones that hurt our environment.
As Canadians, we're always told that the fossil fuel extraction industry is the beating heart of our economy. That's absolutely not true. And here's the other thing. $1 million invested in the fossil fuel industry produces just 2.7 jobs. $1 million invested in any of the Clean Reset programs on which we were suggesting that government focus produces somewhere between 5 and 20 jobs. Clean jobs, jobs of the future, and programs where taxpayer investment would typically be fully repaid to the government within 2 to 3 years. It's not just spending. Government can drive immediate jobs action by making some basic regulatory changes. The Clean50 CleanReset plan includes a broad range of ideas for government reset action, captured in a series of webcasts, podcasts, and videos, all featuring Clean50 award-winning experts. I encourage you to watch or listen to them all and get them from the same place where you consumed this one. More importantly, I'll ask you to do 2 other things. The first is to forward links to these videos to all of your elected officials. In particular, let's get MPs of all parties better educated on what the low carbon economy can look like for Canada, because many don't have a really good idea. The clean economy is durable, well-paid jobs that are not reliant upon the price of oil, as determined by Vladimir Putin or some Saudi sheikh. And the second thing is to send an email, or even better, make a phone call to your MP. Ask them to vote for a clean reset going forward. Tell them it's time to build a low-carbon Canada for the 21st century. For more information on the Clean50 and all our past award winners, please visit clean50.com. I'd like to thank the Trache Family Foundation and the Ivy Foundation for their incredible support, as well as that of our other sponsors, who contributed to making these casts possible. I'd like to thank you for watching, and I'd like to thank you for contacting your MP. It's critical. Let's make sure that this time through we have a clean reset.